Let's go ahead and go through the solution to the consolidation of a wholly owned subsidiary acquired at book value. And as always, the first order of business is to copy, paste as values. Okay, big company purchased 100% of little company on January 1st, 20 for $430. The investment was acquired at underlying book value, and all of Little's assets and liabilities had fair values equal to book value. In 2020 and 2021, Little reported earnings of $53 and $65 respectively. In 2020 and 2021, Little declared and paid dividends of $20 and $20 respectively. Trial balances for the date of acquisition, January 1st, 12/31/20 and 12/31/21 are given for both big and little. Required: prepare elimination entries and complete a consolidation of date of acquisition. Next, prepare equity method entries and elimination entries for the years ended 12/31/20 and 12/31/21 and complete the consolidation worksheets. Note: after cutting, pasting the values in the usual fashion, complete the consolidation worksheets in the templates below. So here we have our templates for those worksheets. Let's go ahead and do our consolidation at acquisition first. That should be fairly easy. Again, at the date of acquisition, there's no income, there's no dividends. All we have is that initial S entry. And again, we're going to eliminate the subsidiaries' beginning of year common stock, their beginning of year retained earnings, and we're going to close that against the investment in Little. Okay, excuse me. Note a couple things. The beginning of year book value of the subsidiary was $430. We are the sole owner of the subsidiary, so the entire $430 is matched against our investment in Little. And very conveniently, that equals the balance in the trial balance. This is the hard part, doing the elimination entry. Once you do the elimination entry, it's all mechanical. Take the debits, post them to the debit column, take the credit, post it to the credit column, and complete the worksheet. So we're going to go ahead and debit common stock for 46. We're going to debit retained earnings for 384, and we're going to credit investment in Little for 430. Now we add across each row, keeping in mind our debit and credit rules. For cash, there are no adjustments or no eliminations, so we simply add across. Likewise, other current assets. For the investment, we have a $430,000 debit offset by a $430 credit, which leaves us with a zero balance. Property, plant, equipment net, again, no adjustments, so we simply add straight across. Going down to the credit side of the balance sheet, again, we have our liabilities, we add those together. For our equity accounts, we have the parents' beginning of year common stock plus the subsidiaries' beginning of year common stock offset by that $46 debit to common stock. And the same thing for retained earnings. Now, a check figure built into all this is that when you're done, the balance sheet needs to balance. So here we have assets minus liabilities and owner's equity all works out to zero. So one check figure is the balance sheet has to balance. Another check figure is, again, this investment has to go to zero. If the investment doesn't go to zero, then something is horribly wrong. Okay, let's go ahead and go down to the end of 2020. And let's do our equity method entries first. Let's do those over here to this side. So, income and dividends. We have our investment income. And again, we are the sole shareholder, so we're going to get 100% of Little's reported earnings of $53. Now note that I pulled that $53 right off of the trial balance in this three-part consolidation worksheet. Again, referred to as a three-part worksheet because we have our income statement, part 1, our statement of retained earnings, part 2, our balance sheet, part 3. Likewise, the dividends we receive. Little pays dividends of $20. I pulled that right off of my worksheet. And since we're the only shareholder, we get all $20. And that reduces our investment. Okay, real quickly, let's just confirm that this investment in Little balance of $463 is in fact accurate. Now again, beginning of year balance was $430. It's now $463. What caused the change? Well, we have our beginning of year balance, $430, plus our income minus the dividends we received. So there's our 463. Okay, so let's go ahead and do our elimination entries. Again, we're going to have to eliminate the beginning of year owner's equity accounts against our investment in Little. And just as it was the date of acquisition, beginning of year owner's equity, we have common stock 46. Common stumbling block, we're going to eliminate beginning of year retained earnings. Now this number down here in the balance sheet, this is our ending retained earnings. We want to eliminate beginning retained earnings up here in the beginning of the statement of retained earnings. And so there's the firm's beginning of year book value. We own all of that. So there's S. A for amortization, not applicable. I for investment income. Again, this should be the easiest entry of them all. We look at the income statement and say, hey, look, there's $53 of investment income. That investment income needs to go away. So income, if positive, is a credit balance. So to eliminate investment income, we're going to debit investment income. Whoops, it's the same number, but just for reference, that should be this cell here. And we close that against our investment in Little. Likewise with the D for dividends. Little declared dividends of $20, so we're going to go ahead and close their dividends declared. Now dividends declared is a debit balance, so to close it or eliminate it, we're going to debit it. And again, we are the only shareholder, so we're going to close that entirely against our investment in Little. So please note what we've done as far as this investment in Little account is concerned. Just as that investment in Little was created as our beginning balance plus our investment income minus the dividends we received, just as that balance was created in 3 parts, beginning balance plus income minus dividends, we're getting rid of it in 3 parts, beginning balance, income, dividends. Okay, let's go ahead and jump ahead to 2021. And again, because, I don't want to say I'm lazy, but because I'm being frugal with my time and energy, I will simply take these entries and copy and paste. That'll get me my account titles at least. Oh, before we do that, obviously we need to go ahead and post this stuff to the worksheet. Again, this is the hard part. Doing the elimination entries, sorting through those is the hard part. Once you get this part down, it's all mechanical. Now, something that's really, really, really important, it's going to get more important as we go. It's important now and it will continue to be important. You need to be sure that you clearly distinguish between your elimination entries and your equity method entries. Equity method entries actually recorded on the parent's books. Elimination entries are worksheet entries, not actually recorded on the in the parent's actual journal. So really important, especially when you're submitting work, it's important that you make a clear distinction between those 2 groups of entries so I know that you know what you're talking about. Okay, so let's go ahead and post this stuff to the worksheet. Again, debiting common stock, debiting beginning retained earnings. We always adjust beginning retained earnings and then let it flow through to ending retained earnings on the balance sheet. And we credit the investment in Little for $430. Next, this entry, we debit investment income up in the income statement, and we credit the investment in Little. Finally, dividends declared, we debit the investment in Little, credit dividends declared. Okay, now again, this is a fairly short example, just 3 entries, but just to be sure, let's go ahead and foot these adjustment columns. So I'll go to my auto sum, and I want to sum everything here. So total debits 503, total credits 503. That means that I've posted, for every debit I posted a credit and vice versa. If those 2 columns don't match, then your answer is going to be wrong. No ifs, ands, or buts about it. So we've got some assurance we've done things properly. Not a guarantee, of course. We might have reversed to entry. We might have put a number in the wrong row, but at least our debits equal our credits. So let's go ahead and work through our worksheet now. Sales, we simply add across. There are no adjustments. Expenses, we simply add across. There are no adjustments. Investment income, again, positive income would be a credit, so we've got 53 credit offset by a 53 debit. Now, something that's really important is whenever you get to a subtotal or a total or a calculation in the consolidated column, you want to be sure to work your way down. Don't simply add across. If we were to simply add across that row, we'd have 155. 102 plus 53. That is not correct. That 155 double counts Little's income. Little's income of $53 is included obviously in Little's income statement, but it's also included in Big's investment income. So when we get to a total in the consolidated column, at the end of our income statement, we want to work our way down the statement. So we have combined sales revenue of $1,700 minus combined expenses of $1,598 for combined income of $102, which we immediately post down to the statement of retained earnings. And the reason I stress posting it immediately is because when we get down to this stage, we might be tempted to simply add across, but then we see the number's already there, and that causes us to catch ourselves and say, no, I don't want to add across that row. That number was pulled down from my income statement up above. So beginning retained earnings, credit plus credit minus debit. My income is already there. Dividends declared, debit plus debit minus credit. So my ending retained earnings, again, I'm getting down to a calculation or a subtotal. I don't want to add across. I don't want to add 1,009 plus 417. Instead, I want to work my way down the consolidated statement of retained earnings. So beginning retained earnings plus income minus dividends gives me my ending retained earnings of $1,009, which I immediately transfer down to the balance sheet as ending retained earnings. Now, as you may have noted, beginning consolidated retained earnings is the same as Big's beginning retained earnings. Consolidated ending retained earnings is the same as Big's ending retained earnings. That is a reliable check figure for the moment. As we start getting into more complex problems, that will no longer be a reliable shortcut you can take. So please don't try to take that as a shortcut. Okay, balance sheet. Cash 53 plus 36, other current assets 72 plus 59. Check figure, the investment in Little has to go to zero. So what have we got? We've got a debit plus a debit minus a credit. That goes to zero like it's supposed to. Property, plant, equipment net, we simply add across because there are no adjustments. On the credit side, credit plus credit. Common stock, credit plus credit minus debit. And I've already got my retained earnings in place. And again, final check. Let's make sure our balance sheet balances. So debit plus debit plus debit plus debit minus credit minus credit minus credit goes to zero. I'm happy. Okay, year two. Again, I've already copied my account titles down here, so this should go quickly. My investment in, I'm going to get that down there. My investment income. I'm the sole shareholder. I, Big, am the sole shareholder of Little, so I get 100% of Little's income. Likewise, dividends. I'm the sole shareholder, so I get 100% of Little's $20 in dividends. Now let's go to our elimination entries. Again, we eliminate our beginning of year owner's equity account, beginning of year common stock, beginning of year retained earnings. Again, I can't stress enough. Beginning of year retained earnings, not the number down in the balance sheet. That's ending retained earnings. Beginning retained earnings this year is ending retained earnings from the year before. So what we'll see a lot of is that what we do in one year flows through to the following year. Okay, investment income, again, easiest entry of them all. We see there's investment income of $65. That has to be eliminated. Dividends declared, $20. And again, we are the sole shareholders, so we got all of that. Okay, so again, we've done the hard part, our 3 elimination entries. At this stage of the game, it should be a visceral impossibility for you to make a journal entry that doesn't balance. So we have 3 journal entries where debits equal credits. Now it's a matter of posting to the worksheet debits to the debit column, credits to the credit column. So again, common stock, beginning retained earnings, can't stress that enough, and the investment in little. A debit to investment income, a credit to the investment in little. A debit to the investment in little, a credit to dividends declared. And again, just to double check to be sure, let's go ahead and sum up these debits and credits. Debits 548, credits 548. So again, not a guarantee I did it right, but at least I didn't do something silly like, post a debit twice instead of a debit and credit or something to that effect. Okay, so let's go ahead and work through our worksheet now. And again, we'll simply add across, keeping in mind our debit and credit rules. And again, remembering that when we come to a subtotal or a total or a calculation, we work our way down. So we're going to work our way down the income statement, we're going to work our way down the statement of retained earnings, and we're going to transfer that ending retained earnings down to the balance sheet. So sales, credit plus credit. Expenses, debit plus debit. Investment income, again, check figure number 1. This has to go to 0. Credit, if it's a positive income, minus debit, goes to 0. For our income, sales minus expenses. That number gets immediately transferred down to the statement of retained earnings. Now we can work through our statement of retained earnings. Beginning retained earnings, credit plus credit minus debit. Income is already there. Dividends, debit plus debit minus credit. Any retained earnings, we work our way down the column again. So beginning retained earnings plus income minus dividends, which we immediately transfer down to the statement to any retained earnings on the balance sheet. Okay, finally our balance sheet. Again, working across each row. Cash, no adjustments, so we simply add across. Other current assets, we simply add across. Check figure number 2. Investment in little has to go to 0. So what do we have? We have debit plus debit minus credit. That goes to 0. And then finally, property, plant, equipment, debit plus debit. On the credit side of our balance sheet, debit, credit plus credit. Common stock, credit plus credit minus debit. And we've already got retained earnings in place. And again, final check, debit plus debit plus debit plus debit minus credit minus credit minus credit equals 0. So the balance sheet balances and all is right with the world.